Welcome back to channel. Today I'm going to explain regression analysis in the simplest possible way using a real case where we estimate utilities cost based on machine hours. By the end of this video, you will fully understand R squared, p-values, t-stats, and how to interpret regression results the way managers and accountants do. Regression is a statistical tool that helps us estimate a cost function using historical data. In this case, the dependent variable or the outcome is utilities cost. The independent variable is machine hours. We want to understand how much utilities cost change when machine hours change. Before we analyze results, we need to understand three core concepts. Economic plausibility. Does the relationship make sense? Goodness of fit, or R squared. How much of the cost variation is explained by the driver? Statistical significance. Is the result meaningful, or could it just be random noise? Let's start with logic. If machine hours go up, utilities costs should go up. Machines consume electricity, water, air pressure, and more. So machine hours is a completely reasonable cost driver for utilities costs. This step is important even if the statistics look good. The more must make business sense. Now let's look at R squared. Here R squared is 0.596, meaning almost 60% of variation in utilities cost is explained by machine hours. That is a moderately strong relationship. This is not perfect, but it's good enough to use for decision making and forecasting. Next is statistical significance, which tells us whether the relationship is real or just random. Here's what we see in the output. T-stat is 3.84, which is greater than 2, meaning machine hours significantly affect utilities costs. P-value is 0.003, which is well below 0.05, so very strong evidence. Significance F is 0.003, also below 0.05, meaning the entire regression model is statistically significant. So this model is not random, it is reliable. From the regression results, the estimated cost function as utilities cost is equal to 37 plus 15.0236 times machine hours. This tells us two things. The fixed utilities cost is about $37. The variable cost per machine hour is about $15.02. This is extremely useful because now the company can predict utilities costs based on planned production. Let's say the factory expects to use 90 machine hours next week. Plugging into the equation, 37 plus 15.0236 times 90, which is $1,389.12. This is how regression becomes a practical forecasting tool. To wrap up, machine hours is a sensible and economically plausible cost driver. R squared shows the model has reasonable predictive power. All statistical tests, t-stat, p-value, and significance f confirm the relationship is meaningful. So yes, this regression model can be trusted and can be used for estimating future utilities costs. If you want more accounting tutorials like this, don't forget to subscribe.